Good morning, good afternoon, good evening. My name is John Matthews. Welcome to this webinar. This is Can Central Banks Engineer Resilient Economies? I'm the Executive Director with AGWA, the Alliance for Global Water Adaptation, and I'm representing a larger consortium called Water Resilience for Economic Resilience. We have an exciting session this morning, and with a great wealth of speakers. I'm going to give a very brief introduction before handing over to two central bankers, and then there'll be, I think, an incredibly rich panel discussion with three very different representatives working in this space, and a great moderator too. And then some final comments from a member of the Spanish government who works actively in this space around resilience and economic management. Next slide, please. The consortium Water Resilience for Economic Resilience is almost 5 years old now. It's the idea behind it is that resilience is not a traditional way that we have tried to manage economies, and it's a diverse group of institutions that have come together to try to articulate what resilience means in economic management, practice, and policy, especially at macroeconomic levels. Next slide. Our goal is really to think more broadly, to help our countries, our communities, even our ecosystems become much more ready, prepared for the more complex world that we are very rapidly entering in right now. Last year, we published a guide, Managing Water for Economic Resilience, De-risking is Not Enough. You can download a copy at the link that's provided here. And we hope that you'll reach out and join our initiative too. It's a growing group, and we have many webinars in this series already and many more planned. And we'd be eager to work with you in outreach, but also in some of our tangible projects. Next slide, please. So the topic for today, it's really become a truism just in the past 2 years, but I would say actually, especially in the past 3 or 4 months, to see that we're entering into a much less certain world, and that the complexities for how we try to manage ourselves, what we think of as making progress socially, economically, ecologically, has become much more muddled. Our past is not necessarily a useful guide for the landscape in which we find ourselves walking into now, much less in a year or 2 or 10 years. Conflict in India and Pakistan, and turmoil in markets, turmoil within individual governments are all some of the abundant examples. In that sense, the concept of resilience in my work has really changed. I've been working in the climate change, adaptation, resilience, and impact space this year for over 21 years, and I have really opened up what it is that I think we need to be resilient to and for, and what even resilience itself needs to mean in practice. And I think what we're hoping to be able to see today is an unfolding of that. And I'd like to really begin by handing it over, because we have such a rich set of speakers today, to the first of the two keynotes. The first is Sjoerd van der Zwaag. He is currently a senior sustainable finance officer at the Dutch Central Bank, the DNB. Sjoerd is part of DNB's Sustainable Finance Office, a central hub that coordinates the implementation of their larger sustainable finance strategy. His primary responsibilities include coordinating DNB's efforts with regards to nature. Sjoerd is also an advisor to the co-chairs of the NGFS Task Force on Biodiversity Loss and Nature-Related Risks. You're going to hear a lot about the NGFS group, I think, over the course of this talk. Within this task force, he led the work on the conceptual framework for nature-related financial risks. Sjoerd, the floor is yours. Thank you so much for joining us.
Thank you very much, John, and a pleasure to be here today. Provocative title as well. Can we engineer resilient economies? I think the honest answer is probably no, or at least not by ourselves. Certainly governments have a large role to play, but we do have to play our part. And I think that is what I hope to elaborate on today, explain a bit more where we come from as central banks, why this topic is relevant to us, and what some of our actions are in this space. And I think as a starting point, it's important to know that, of course, resilient economies rely on resilience of nature. And I think that is my main subject of today, the importance of nature and the risk that nature degradation poses to the economy. So I'll take it slightly broader at the start, focus on nature in the wider sense, and then try to narrow it down to some of the water-related examples. Next slide, please. So I guess as a starting point, it's important to clarify why we care. And it might be obvious to some, if not many of you, but I think it's not always that obvious. So it's an important starting point. And I think here the critical bit is that nature degradation could lead to significant financial risk. The NGFS, the Network for Greening the Financial System, is a network of, I think by now, over 140 collaborating central banks and supervisors that started off with work on climate change, but now broadened the scope to include nature-related risks as well. And they issued a statement in 2022 stating the following. It's on the slide, but I think in summary, that these nature risks could have significant macroeconomic implications, and that failure to account for those is a source of risk for financial institutions, but also on a systemic level for financial stability. That is why we care, and that's also why we take action. Next slide, please. Now, I think before we dive into detail here, I think one of the things we've experienced in sort of embarking on this work is that it's important to have a shared language to speak about these risks, both among ourselves, but also with wider stakeholders, because there are various terms. These terms have different meanings, and otherwise there's a large risk of talking at cross purposes. So let me start with that, hopefully also as a way to find each other in the conversation going forward. So when I speak about nature, of course, that is a term that's very difficult to define, and I don't want to pretend I can define it for everyone or everywhere. But when I speak about it, I mean the living and the non-living components of our planet. And we interpret that as combining in ecosystems, forests, wetlands, etc., that yield a flow of benefits described as ecosystem services. And the ability of nature to provide those services depends on biodiversity. And that biodiversity for us really refers to the variability of living organisms, which includes diversity of species, between species, and of ecosystems. So it's a key characteristic of healthy ecosystems. And clearly, water is an important part of that. And I think the reason why I mentioned that is because you have all these different dimensions of nature that are heavily interconnected. On the right-hand side, you see how the different planetary boundaries interconnect, which includes freshwater use. But I think that is why, certainly from an NGFS perspective, we stress the importance of an integrated approach, because you cannot look just at climate or just at water. You always have to consider the broader picture. Next slide, please. So how do we do it? With the NGFS, we've been working quite hard to come up with a conceptual framework on nature-related risk, effectively as a way to come up with this common language, but also to break up this complex question into manageable bits. And we've established transmission channels to showcase how degradation of nature could in the end lead to economic risks and financial risk. And of course, when it reaches financial risk, that is also why we start to care as central banks and supervisors. So in a nutshell, you see here the picture that's also in the publication. We start off with nature degradation that could lead to what we call physical risks, so the decline of ecosystem services on which our economies rely. but also transition risk. So transition policies, changes in investor sentiment or consumer sentiment, and the fact that some economic actors might not align with those. So both are sources of risk, and that could have effects on our economy. That could have effects on a micro level, affecting individual households or businesses. So you can think of a farm that's facing degraded soil, or a household that's making use of the water nearby and can't do so anymore. But there's also macro effects to consider. The effects on prices, for instance, be it food, water, energy, productivity, health, you name it. And those economic risks can turn into financial risk. And we sometimes say that nature risk or water risk are only a source of risk that can just translate into the traditional risk categories that we know. A credit risk, market risk, underwriting risk, and a few others. And in that sense, it's not fundamentally different than some of the other risks we also need to manage. It's just that the source is different. And those traditional risk categories are not the endpoint. So I think it's important to note here that there are feedback loops to consider. So these nature risks could lead to contagion within the financial system. If one actor is affected, it could affect others. There are feedback loops between the financial system and the economy. But there's also what we call endogenous risk. So the impact of the activities we finance on nature, and in turn the risk that creates. And this is how we approach nature-related risks, which includes water risk as a subset of that. Next slide, please. I think here it's important to highlight that indeed water often stands out as a particularly relevant source of risk. I'm referring as an example here to some of the recent research done by the ECB, who've looked at the exposure of both the non-financial corporates, but also Euro area bank loans. And it showcases, and you see that on the right-hand side, that quite a lot of exposure is to these water ecosystem services. So you have surface water there and groundwater there. And it comes to the conclusion that surface and groundwater, together with mass stabilization and erosion, represents the major potential sources of physical risk for banks. And I think that is an important conclusion to highlight. In other words, it's a material risk for us. Next slide, please. So how can we then act? And I think this is, of course, the challenging bit. So in addition to this common language and set of definitions, we developed a high-level conceptual framework, a risk assessment framework. And what we try to do is break it up in 3 parts. Phase 1 really asks central banks and supervisors to identify the sources of physical and transition risks. And we do that on the basis of a number of guiding questions to pinpoint some of the elements you might want to pay attention to. Starting with current exposure. So what are your exposures to some of the high impact and high dependency sectors? And where do you depend on nature? Where do you impact nature? And on the basis of such an assessment, you can prioritize. And as you've just seen, you could, for instance, decide that water is a topic that often features. You can, on the basis of that, select certain ecosystems you want to focus on. But you can also focus on particular sectors that stand out as having high impacts and dependencies and that are relevant to your economy or to your financial institutions. But in doing so, it's important to note that cannot be done by only looking at current exposures and current priorities. Of course, you need to consider how that will develop going forward. So we also ask attention for that forward-looking view, and this is often where scenarios come in to test the different possible outcomes. And finally, we point towards the climate-nature nexus. So I think certainly for people that start with a climate lens, it's important to consider how it connects to these broader nature questions. And there we try to simplify it a bit by highlighting 4 dimensions. So the fact that climate change can amplify nature risk, but that nature risk can also amplify climate risk, that therefore mitigating climate change can help, but not necessarily, because there could be trade-offs. And that restoring nature almost always is also good for climate change. So that is a way to break it down. Now, this can be quite conceptual. So to provide some color to the framework, we've also developed some illustrative cases. And before I highlight examples from that, I think it's important to mention that these cases are really examples. They're meant to provide color. to provide some examples from existing literature, but they're not comprehensive. They're also not meant to provide policy recommendations for the jurisdictions affected. It really is just an example. But keeping that in mind, I think it's important to note that one of the illustrative cases in this document, so the conceptual framework, is focusing on the Colorado River Basin because it's one of the very recognizable water ecosystems. There's also a large wealth of English language literature available on it, making it easier for us to study it on the basis of already available materials. But of course, you could select other water ecosystems and perform similar analyses. And in doing so, in this phase, identifying sources of risk, it already shows that, for example, in this case, agriculture and hydroelectric power stand out as having significant impacts and dependencies on the basin. So that is one way to prioritize, to focus on some of these sectors. It's also good to see how it will develop going forward. So I think here it's one of the conclusions that stands out is that the basin provides a role in the regional and global hydrological cycle, thereby also influencing other ecosystems connected to the global water circulation and changing rainfall patterns. So going forward, certainly whatever affects the Colorado River Basin can also have an impact on other ecosystems elsewhere. And that the escalating frequency of droughts worsens the problem. So it can increase physical risk over time. One of the things we quote here is that climate-induced decline resulted in 19% to 31% in the Colorado River flow by 2050 in a worst case scenario. So it's trying to draw out some of the examples of how it could affect the economy. Next slide, please. Now, we cannot afford to just look at exposure because exposure is not the same as risk. We don't know necessarily if a risk will materialize, and we don't know how vulnerable actors are to that particular risk. So that is why in the second phase, we encourage central banks and supervisors to also assess the economic risks. And again, here we draw attention to a few dimensions that we consider relevant. So first of all, value chains. Whatever happens to an ecosystem or sector has direct impacts in the region affected, but of course can also cascade through value chains, indirectly affecting other industries and households. We also ask attention for the micro-macro interaction. So as just mentioned, risk can have an effect on a micro level, but we shouldn't overlook the macro level impacts here. And finally, we call attention to the vulnerability and substitution and the fact that there might be some substitution options available, but that in the end, those options aren't infinite. So we can't substitute our way from nature. To bring it back to the Colorado River case study, a few points to note here. So first of all, that decreased water flow hampers the generation of hydropower in the region, affecting energy production for households and industry. So that is one of the more direct effects. But here again, and this is the value chain point, that prolonged droughts in the Colorado Basin can also have the potential to result in indirect economic effects, including through food and energy supply chains. And one way to measure those effects is through using some of the multi-regional input-output tables. We have another document specifically on scenario development where this is highlighted, and an example is given for drought in France if you're interested. And then the final point to stress here is that economic actors remain vulnerable to these risks given the limited technological and geographical substitution options for fresh water. So here, of course, you could think of innovative agricultural practices as a way to lower your demands of water. You could move to different regions, but in the end, that is not infinite. Next slide, please. And then as a final step in our framework, we ask attention for the financial risk. So assessing risk to, from, and within the financial system. And here we draw attention to three dimensions. So first, the transmission to the traditional risk categories, as just mentioned, the credit risk and the market risk. We call attention for the systemic dimension. So this is the contagion point I mentioned before, the fact that if one financial institution gets affected by this risk, through interlinkages with other, it could have a wider effect on the financial system as a whole. And finally, endogenous risk. So the negative impacts that finance activities have on the state of nature, and therefore some of the physical risk we in turn need to manage. Also here we have some examples related to the Colorado River. For instance, estimates suggest that the contribution of finance in the insurance sector to the regional gross state product could decline by around 137 billion if the Colorado River is unavailable for the year. So it showcases the importance of rivers like this or ecosystems like this also for the financial sector. Also here, I think this is more on the systemic dimension. Elevated water prices have the potential to impact the wider financial system and trigger some of the feedback loops to the real economy through increased commodity prices and cost pressure. So it's not just a very local effect, it could really ripple through some of the other sectors as well. And then finally, of course, financial institutions also fund some of the more harmful economic activities. Think of water-intensive agriculture, for instance. And why do we care? It's because in the end, it could aggravate some of the financial risks that need to be managed later down the line. All of this to showcase that from a central bank perspective, resilient ecosystems are important because the degradation of nature could undermine the resilience of our economies. And clearly, as risk managers, we have a role to play there. We have a role to play by pinpointing these risks, by making people aware of these risks, but also saying to our financial institutions, certainly in the Netherlands, that these could be material risks that need to be managed just like any other risk. Next slide, please. Now, with these documents, so the conceptual framework as well as the technical document on scenarios I just mentioned, we made a start, and there's some really good water examples in there, including the illustrative case, if you're interested to learn more. But it's also just the start of a journey and the start of a conversation. So we'll continue this work within the NGFS in a number of ways. First of all, we want to continue the development of scenarios for nature-related financial risk to really bring in that forward-looking perspective and not just look backward, but also see what's on the path ahead. Second, we want to develop a compendium of implementation practices to demonstrate how the conceptual framework could apply. The illustrative cases are a start, but there's more there. So we really want to focus on implementation and operationalization there. And then finally, we want to initiate some policy research on some of the nascent topics to facilitate further integration in the other NGFS working groups. So you can think here, for example, on nature transition planning as an example. So maybe to conclude, this work will continue. Hopefully it has shown that for us, nature-related risks are a source of material risk for the financial sector and therefore will frequently fall within the mandate of a central bank to act. It is also a complicated topic, a topic that requires conversations like these. So looking forward to the next sessions and of course, happy to answer any questions. Thank you very much.
Thank you so much, sir. That was a fantastic talk and really interesting. I'm going to maybe ask a quick focusing question of you before we hand over to the next keynote. I want to acknowledge I'm an ecologist by training, dabbling in very primitive ways in economic spaces. But it's to me it's truly remarkable to see the transition that's occurred in relatively recent history in the mainstreaming of this sense by economists that we need to really bring in thinking about not just nature risks, but the importance of natural capital in how we manage ecosystems. I loved some of the terms that you were able to use. You talked about contagion between institutions, but I think you're also talking about potentially the contagion of risk between natural systems and economic systems, ultimately, and normalizing that as a process. I guess my question is that in the climate change world, risk is an important part of how as we think about climate impacts and how they affect projects and institutions and whole programs. There's been a shift from primarily focusing on risk especially using some other terms that you've alluded to, like exposure and sensitivity, to saying that we need to also think about resilience as a separate concept, that and accounting for risks is really important. It will always be important, but resilience may be a larger concept too. It's something that is above and beyond, and we don't want to simply reduce resilience to merely fewer risks or less severe risks. I wonder if there's a similar kind of evolution that might be occurring in economic thinking about trying to include a concept like resilience as something that's different and beyond risk itself.
No, it's a very good question. To me, I think it's important to sort of, I think you started with, I'm an ecologist. It matters where you come from. So as a central bank and supervisor, our frame is often risk, and resilience then becomes part of that. So in my view, when we speak about resilience, I think the time horizon question is critical. And I think you can think about risk in the short term, and I think then it becomes more operational or maybe simplistic. And I think if you think about resilience, you're not just thinking about the risks of tomorrow, but really the long-term risks. And that could have broader dimensions. But I think for us as a central bank, I think that the key question is, how do we make sure that our economies are resilient? But I guess as part of that, then also that our natural capital is resilient, because these risks only need to be managed in the short run, but also in the long run. I think that is where, as a central bank, we typically have a slightly longer time horizon over which we look. So it could make it more interesting. But it also demands a conversation with people from other sectors and other perspectives, because resilience could mean different things to different people.
That's incredibly important, and I'm really grateful for that response. I think it's going to feed very much into the next set of discussions, and look forward to seeing you on the panel again. Thank you so much. I'm going to hand over now to our next keynote speaker. We're very excited about him as well. Ángel Estrada recently joined the advisory office of the Banco de España's governor, where he has spent most of his professional career in various departments. Ángel has held positions in the government of Spain as well, beyond the Banco de España, culminating in his appointment as Director General of Macroeconomic Analysis and International Economics at the Ministry of Economy and Finance. On his return to the Bank of Spain, he worked on operational aspects of macroprudential policies, and later on the coordination of the Deputy General Directorate for International Affairs. He was appointed Director of the Department of Financial Stability and Macroprudential Policy before becoming the Director General of Financial Stability, Regulation, and Resolution until the end of 2024. You meet us, Ángel, after a very impressive career. And it sounds like you have also been on not just a journey across many different kinds of positions and many different types of institutions, but also a journey in your own thinking too. And I believe we'll hear about that right now. Thank you so much. Gracias.
Thanks a lot, John, for inviting me to this presentation to give you this presentation on the things that we are doing at the Banco de España with respect to climate change. Good morning, good afternoon, everybody, and let's go with the presentation. If you move to the next slide, basically what I am going to try to explain you is first some introductory remarks that has been, some of them has been underlined, of the main remarks that has been underlined by Short, so I'm going to be quite brief in this respect. Then the regulatory and supervisory activity that has been performed not only in Spain but also at the European level in the space of the banking union. Then the recent research that we have been doing at Banco de España related in particular to the physical risks and specifically related to water. And then my final point is going to be related to the recent materialization of physical risk in Spain, that is the impact of the recent floods in Spain, in Valencia in particular. So if you move to the next slide, The first, this slide is basically a reminder of what Sor was saying before, that the financial sector, the institutions, and also the regulator and the supervisor should take into account the climate risk into their decision making. Why? Because they affect they represent a risk for the financial institutions and for the bank in particular. Basically, the risk drivers are physical when the climate change materializes, or the transition when the authorities and technological changes or behavioral changes may do things in order to avoid the climate change. Initially, we were more worried with the transition risk because we consider that they were closer in the time horizon, but now we are conscious that the physical risks are beginning to be very relevant too. And the financial risks associated to the climate risks are basically the same that we used to analyze in the past: credit risk, market risk, operational risk, and so on. So it's necessary that we and the institutions take into account the risks, and by incorporating these risks in the decision making, it contributes to the fight against climate change, basically because they internalize in the prices and in the decision in general, the externalities that represent for example, the issuance of CO2, of carbon, and so on. If you go to the next slide, the second idea in this introduction has been also highlighted by Sor. Basically, the regulatory and the supervisory authorities can only play a companion role in this fight. Basically, are the governments the ones that have the tools and the legitimacy to fight climate change. Here you have two examples of what could happen if only the regulatory and the supervisory authorities do something in this respect. For example, if we introduce risk concentration limits for highly pollutant economic activity, in the case of the portfolios of the banks, there could be problems with the transition and also with the people that now is working in these activities. The question that I think it should be made is, these activities can be made using cleaner technologies or not? If the answer is yes, it's clear that those activities would need more financial resources in order to finance the transition. If the answer is not, probably that industry should be closed, but we should not forget that that industry had workers, people that probably would need support in order to transition to other activities. The second example is also very similar. If we increase the risk weights for non-environmentally friendly houses, if we do that and take it into account that the classification, the environmental classification of a house is related to the quality of the construction and therefore to its price, it's very clear that if we don't compensate this and we do not help the poorest household, the low-income households, in order to support a higher quality and therefore more environmentally friendly housing, there is going to be people that is going to be out of the housing market. And it's very important, in my view, that we don't leave behind anybody, because it's essential to have the support of all the population. So if you move to the next slide, my idea now is to share with you the regulatory and supervisory activity that we have had in the banking sector in the recent years. You move to the next slide. Starting with the regulation, the first idea is that the evolution of regulation has been relatively heterogeneous across jurisdiction. Not all the jurisdiction has moved at the same speed. And in particular, the European Union, I think that we have adopted a more, let's say, ambitious approach. Basically, in the regulation of the banks, now we have three pillars. The pillar 3, that basically is the provision of information to the market and all the stakeholders. The second one is the supervisory review of the activities of the banks, and the pillar 1 are the minimum requirements, minimum capital requirements for the banks. So the first pillar, it was the third pillar was the pillar in which we started to work the sooner. And this is basically because when we start to work with this climate risk, the first gap that we found was that we didn't have, or we had very few information on the exposure of the bank to climate risk. So the first idea, the first development was to elaborate the information that we need in order to assess the risk embedded in the banks, in the portfolio banks. And now, for example, in the case of the European Union, there is a prudential disclosure of this information. The second pillar is the pillar in which we are working now the most, and is related to the initiatives of the supervisors in order to incorporate the risk in the decision making of the banks. And this implies basically to introduce in the analysis of the risk of the banks the climate risk. And also, for example, there has been some studies analyzing the macroprudential treatment of the risk. Pillar 1 is the pillar that is more delay in the analysis because there are some controversies on if those risks should be addressed in the pillar 1. Basically, because the pillar 1 traditionally has a horizon that is 1 year, and it's very clear that climate change, the risk associated to climate change requires a horizon that is much longer than this, and also due to the information, the data, the information that we have, because this pillar 1, these minimum requirements are based in very long information of materialization of the different risks, and this is not the case for climate change, that we are now starting to have information on the impact that the materialization of risk has. If you go to the next slide, well, we are going to jump this slide. Please go to the next. Yeah, this is the supervisory approach that has been used in the banking union in Europe. Basically, we have used this escalation ladder, and this escalation ladder is based in a thematic review that the supervisor did with the banks in order to assess if they have incorporated in their decision making and in their management all these climate change risks. So for those banks in which we didn't encounter severe weaknesses, basically the supervisor sent them operational letters in order to even improve the treatment that they have on climate change risk. For other banks in which severe weaknesses were found, the actions were more, let's say, more ambitious, in the sense that there were some, the idea of the banks having a commitment in order to introduce substantial changes in their management in order to incorporate the risk. And there was even the possibility of imposing them additional capital requirements in case they don't improve the situation. And finally, there was the possibility of having penalty payments in case the banks were not able to introduce the changes required. So the supervisory approach has been basically based on escalation of the penalties, of the requirements, in case banks do not incorporate these considerations in their management. So if you go to the next slide, please. It's very important that the banks use the adequate methodologies in order to analyze the impact of climate change. In this respect, the stress tests are playing a very important role. And why the stress test? Basically, because the stress tests allow to simulate different shocks. And this is very important because we don't have enough experience on what are the drivers of the triggers of the different risks, of the risks associated to transition and also those associated to physical risk. And more importantly, probably, is because this is a forward-looking tool. This is a tool that allows to use scenarios and make projection of the situation of the banks for a long horizon. That is a horizon, the horizon in which the climate risk materialize, the climate change risk materialize, usually is much longer than the one that we use traditionally for financial risk. Another element that is very important that was also highlighted by Swart is basically the idea that we need to have an idea of the systemic dimension of the risk, the interconnection among not only the banks but also of the banks with the other subsectors. For example, as you will see in a few slides, for example, in the case of the physical risk, is probably the first line of defense against this the materialization of physical risk is the system of insurances. And the system of insurance make the banks to suffer less losses, but the insurance sector is going to suffer those losses. So it's very important to take into account this systemic dimension, how the climate risk affect all the financial sector as a whole. So if you move to the next slide, please. In this point, I would like to show you very, very quickly some of the recent research that we have been doing at the Banco de España, related in particular to physical risk, both chronic and one risk acute. That is the fourth point of my presentation. Related to what is happening in Spain in the recent year. So if you move to the next slide, the first exercise that we have been performing is trying to analyze the impact that the increase in the aridity in Spain is having in some variable related to the financial sector and also on the macroeconomy. And although here I am going to present the impact on the evolution of credit. And as you can see in these maps, the increase in aridity in Spain has been important in the last decades, but this increase has been unequal in the different regions and in the different areas. And this heterogeneity in the evolution of the aridity is what allow us to identify the impact that the aridity has. So if you move to the next slide, the basic two ideas that we obtain in this chart is that, as you see in the chart that you have on your left, total credit declines as a consequence of the increase in aridity. But it's very important to notice that the impact of aridity in credit, it has the period of time to materialize, to be really, to have an impact important, is very long. It's between 10 and 12 years. So this, I think, that highlights the difficulty in adopting measures to fight aridity because of the long time that aridity takes in order to have a relevant impact on, in this case, on credit, but in activity in general. So this is what is called the course of the horizon. In the second chart, I think that is also very relevant to take into account that in aggregate terms has a negative impact, but there are sectors in which the impact is negative, it's very negative in the case of the agricultural sector or the real estate sector, but there are other sectors in which the impact is positive, in this case, in tourism. So negative impact, long period of time to materialize, and heterogeneity in the impact of the sectors are the main three messages of this slide. If you move to the next slide, also related to water, I'm sorry for I think that the chart are not very, but I think you cannot see very well the result, but I can explain you. This is the impact of the increasing wildfires, also related to the lack, in this case, as in the previous case, of the lack of water on employment. And as it can be seen in the chart that you have in the left, basically the idea is that the increase in these wildfires have a negative impact on employment, on activity in general. There are differences between in the municipalities there are local banks or not, but basically this is the result of the analysis. And if you move to the next slide, I think this is a slide that is very well related to the previous presentation, that reflects the interaction of the environmental degradation with climate change, because there is a interior sea in Spain called Mar Menor, in which, due to the urban and touristic development, and mainly the transformation of rain-fed crops into irrigated agriculture, they have implied an important environmental degradation in this area. And the frequent floods and the extreme temperatures that are related to climate change have exacerbated the situation. So if you move to the next slide, what you can see is a comparison between, using econometric techniques, of course, a comparison between the evolution of the housing prices in that area and the housing prices of houses that were in the Mediterranean Sea, 10 kilometers from the houses that were in the coast of the Mar Menor. And as you can see, there has been a clear impact, a negative impact on the houses that were close to the Mar Menor. And it's very important to take into account that the decline in the prices of the houses in that area is 10 times higher than the profits obtained by the farms that change the way they grew the crops. In this respect, it's very important to take into account also that most of the owners of the houses were living in other areas of Spain, while probably the owners of the farms were living in the same area. And this is very important for the financial sector, because the houses are the main collateral that the banks have, at least in Spain. So yeah, to finalize my presentation, if you move to the next slide, I would like to give you some ideas on the impact that the recent floods had in Spain. You move to the next slide. You know probably perfectly well that we have a DANA in the area of Valencia, in Spain, in the area that is that is marked in brown in this map. Basically, 200 and I think it's 20 something people were killed during the Dana, and this is a clear example of the materialization of an acute physical risk. So if you move to the next slide, this area basically represents 2% of the Spanish economy, population, and so on in different areas. So it's not a systemic event for the financial sector, but is a relevant effect. See, if you go to the next slide, the impact that we have estimated that this had in the Spanish GDP in the quarter it happened, the fourth quarter of last year, was basically a reduction of 0.3 percentage points in the GDP growth. As you can see in the chart that is in the right, the impact was to some extent reduced, will be reduced 1 year after, but the impact is quite significant. If you go to the next slide, the flood, according not to what we have observed in the Dana, but based on other natural disaster that we have had in Spain in the past, has very heterogeneous effect on the credit of non-financial corporations and mortgages. In the case of the non-financial corporations, the impact is it increases the delinquency rate of the loans, and as you can see in the chart, this increase is very long-lasting, in the sense that for example, in the case of the earthquake in Lorca, that is a city in Spain in 2011, even almost 10 years or 6 years after the earthquake, we are identifying an increase in the delinquency rate of the non-financial corporation loans. On the contrary, in the case of the mortgages, there was a slight increase at the beginning when the earthquake happened, but this impact was basically disappeared 1 year after the earthquake happened. If you go to the next slide, and probably an explanation for this heterogeneous impact of the natural disasters in the portfolios of the loan portfolios of the banks is related to the different lines of defense of the disasters that we have in Spain. Because in Spain, there is a public institution that is financed with the premiums of the insurance and so on, that covers all the extraordinary risks, including natural disaster, for all the insurance policies. And this implies that if a house with a mortgage is affected by a natural disaster, the Consorcio Compensación de Seguros, this public company, covers the damages that have been suffered. And this implies that banks are not going to suffer any loss associated to this damage. And this is the idea behind the different response of the non-performing loans in the case of non-financial corporation and in the case of the households. So basically, that was the presentation what I have prepared for you this today. I'm happy to take any question that you may have. Thank you.
Thank you so much, Angel. That was a really interesting presentation, and I think the examples that you gave were also really revealing. A couple of takeaways that I took from your presentation, that we need to think very carefully about indirect effects and transition costs. What I really heard there was that if we make rules that are too simple, that they can really hurt us, and they can affect groups if we're not subtle in our thinking, that they can have very severe unintended effects. I loved the section 2 where you were talking about stress testing. and trying to stress test complexity, which is always really hard, right? To develop more complicated models is always itself a kind of risk of trying to see too much into a system, but try to use stress testing as a way to look forward. The Fit for 55 test is something I am really curious about. Maybe not least because I'm 56 and I'm worried that maybe I'm not fit enough. I also maybe to kind of echo my comments to Sjoerd at the beginning. In looking at the change in real estate value, or the lack of change in real estate value, which is really the point of that slide for the area that had been really ecologically damaged. I mean, I wonder if many of our traditional measures of economic health are around growth, and maybe what we need to think about instead are things like wealth creation, or the rise of new inequities in wealth between different groups as a result of some of these kinds of impacts. And it's a very coarse approximation for, or proxy for thinking about resilience, but it's an interesting one too, right? And maybe one to also link very clearly, in if the financial system begins to fail people, then that is the beginning of the unraveling of even the government being able to make useful policies. Do you have a quick response maybe on that?
No. I fully agree with you. I think that the inequality effects of the measures that can avoid climate change are very clear. If you do not compensate the people that is going to suffer, because, for example, in the case of the consumers, it's very clear that the expenditure of low-income households, basically because they are low income, and energy is a basic consumption. The way they have in the basket of expenses is very high, and what we have also observed in Spain is that most of the companies that they emit more CO2 are also firms that hire more low-income people. So low-income people can suffer due to both circumstances. So it's absolutely necessary to compensate them, because in other case, we are not going to have enough support in order to do this. And something that I think that we learn, for example, with globalization and the internationalization of the economy is that it's not only necessary that as an average we improve, it's also necessary that nobody is left behind. So very important element from my point of view.
A really important message. Thank you so much for your talk. We'll turn now to the panel, and I'll begin by introducing the panel moderator, and she'll in turn introduce the panelists. Lila Davies, who's really been instrumental in helping to put together this webinar, is a policy analyst at the OECD, a real ally of water resilience for economic resilience, and I think a thought leader in this space. She's been leading work on assessing the financial materiality of water-related risks. The OECD will soon be publishing a report providing guidance to central banks and policymakers on embedding water-related risks into financial stability frameworks, taking both a climate and nature lens. Lila also works at the country level with emerging economies to support policy reforms to address pressing water challenges and mobilize investment for the water sector. The floor is yours, Lila. Thank you so much.
Thank you very much, John. Good morning, good afternoon, everyone. I'm delighted to be here to moderate this panel on what is a crucial yet often overlooked dimension of economic and financial stability, water. This is a particularly rich discussion looking at water through both the climate lens and the nature lens, as we've heard in the previous presentations. Looking back, we can see that water-related shocks, we have the evidence, can affect both economic activity and price stability. Stress testing exercises also demonstrate that at sufficient scale, water-related risks can have implications for financial stability. So it's fantastic to see this panel coming together, and this session really gives us a chance to look at water-related risks, not just as an environmental issue, but as a financial stability concern. That's increasingly relevant for financial supervisors and central banks. As John mentioned, this is also an area where the OECD is working, and we'll be publishing a report on this in the coming months. So we'll begin with some targeted questions to each of the panelists, then move into a broader discussion. For those watching online, please feel free to submit some questions via the Q&A feature. We'll try to address these if time allows. So without further ado, please let me introduce the fantastic panel that we have here today. So we're joined by Kate Lamb, who typically needs very little introduction in the water community. Kate is the freshwater lead at the UNEP Finance Initiative, where she supports members in accelerating action to mitigate freshwater impacts and risks. Prior to this, Kate served as the Global Director of Water Security at CDP, and during her 13-year tenure, she built the world's largest coalition of non-state actors working towards a water-secure future. With 25 years of leadership experience catalyzing positive change across the private and public sectors, her work was recognized in 2023 when she was named one of Thomson Reuters' trailblazing women working on climate. We're also joined on the panel with the WWF. So we have Carolyn Carella, research lead for the WWF Greening Financial Regulation Initiative, GFRI. And so Carolyn is responsible for coordinating the GFRI and providing guidance on fresh water to central banks and financial supervisors. Carolyn has extensive experience in sustainable finance, from engaging with private financial institutions in Switzerland to supporting key projects at the GFRI since its inception. Prior to joining WWF, she worked in the global innovation team at Zurich Insurance. And last but definitely not least, we are joined here by Kata Molnar, lead analyst at the Sustainable Finance Department of the Central Bank of Hungary, where she focuses on nature-related risks. She previously served as the water thematic expert at Morningstar Sustainalytics, where she led product development and methodology enhancements on water-related material risks for their signature ESG risk rating product. Kata has a strong background in water policy and risk assessment and has provided strategic advisory work on water and climate issues for institutions including Nordea Bank, SIWI, and UNESCO IHP. So Kata actually has an interesting profile. She's both a central banker and a water expert, and a great addition to the panel. And thanks also to Sjord and Angel for also staying along for this panel. So welcome to these fantastic panelists, and let's dive into some of your work on this topic already. So turning to Kate first. Kate, can you tell us a bit more about the UN Principles of Responsible Banking and how they've been received by central banks?
Absolutely. Thank you, Lila. It's so nice to be here. Thank you for that super warm introduction. I'm blushing significantly, as you may be able to tell, but it's always nice to hear, of course. So there's lots of acronyms in this world, right? We've got the UN Principles for Responsible Banking, or known as PRB, and these were launched back in 2019 by UNEP-FI, the UN's Environment Programme Finance Initiative, another title that rolls off the tongue. These principles are designed to help banks align their strategies with global goals, particularly SDGs, the Global Biodiversity Framework, and of course the Paris Climate Agreement. They have a sister group of principles called the Principles for Sustainable Insurance, which are focused specifically on the insurance sector. But today I'll talk about the PRB themselves. So within the PRB, there are 6 core principles, and they cover everything from aligning with sustainability frameworks to engaging clients and stakeholders, setting measurable targets, embedding sustainability into governance and culture, as well as reporting progress in a transparent way, a topic that, as you know, is somewhat close to my heart. I think it's important for those on the call to understand that these principles are specifically aimed at commercial banks themselves. So central banks don't sign up to them, but many of them, like the Bank of England and the ECB that we heard about before, have shown strong support for the overall goals of the PRB itself. And they've done this mostly through their work and involvement with the NGFS. But that said, I think there are still some challenges. One concern, for example, from regulators is that the PRB ultimately is a voluntary framework. This means that there can be big differences in how seriously banks take their commitments under the PRB, and that there's an ongoing risk that we manage at UNEP-FI of greenwashing if these commitments aren't really backed up by real action. And so that's why central banks, as we've heard already, are increasingly calling for more standardized reporting and ultimately better enforcement of the targets that the banks themselves are setting. But overall, I think the influence of the PRB is growing. It's startling to realize that more than half of global banking assets are now covered by the banks that have signed on to the PRB. So while there's still a long way to go, these principles are helping to push the sector in the right direction. And central banks, I think, are seeing them as a useful complement to their own regulatory tools.
Thanks, that's great. And I understand that UNEP-FI supports banks with a number of different tools and guidance, and also acts to some extent as an interface between the financial industry and governments to facilitate alignment. So maybe could you tell us a bit about some of the other ways in which UNEP-FI is helping banks align with nature-related goals, especially water, of course?
Absolutely. So we have published a whole range of guidance documents that guide members on achieving the outcomes that they've, the commitments that they've set to under the PRB, and you can find all of those on our website. For the last few months, I've been trawling through our existing content to identify which ones work for freshwater, which ones don't, but they're fairly well covered, which is a good thing. We also act as a convener, where we have a number of our members coming together in a whole range of working groups. They're meeting consistently and regularly to talk about topics, whether that is deep as sort of risk assessments and quantifying risk across portfolios, through to targeted and strategic engagement campaigns, target setting, and new financial products that they may be able to generate and put out on the market that will accelerate the transition to sustainable markets that we all need.
Okay, that's brilliant. So I'm going to turn to WWF very briefly to also dive into their work, and then we'll come back for some conversational questions. So Carolyn, could you also tell us about how WWF works with central banks and supervisors on environmental challenges, and especially, of course, fresh water?
Yeah, gladly. First of all, thank you so much for the invitation on this panel. Very happy to be here. So specifically what WWF, or the Worldwide Fund for Nature, does in engaging central banks and supervisors. So, you know, we're like a conservation organization, but increasingly we have acknowledged the importance of engaging central banks and financial supervisors. And that's why in 2020, we launched an initiative, as you already mentioned it before, the Greening Financial Regulation Initiative, or short GFRI. And this is a global initiative that aims at supporting central banks and financial supervisors and regulators to really start mainstreaming the consideration of climate and other nature-related risks into their decision-making processes. And in this initiative, we work across different work streams, we call them, with the ultimate aim of really supporting needs that central banks and financial supervisors have in navigating this field. So we provide, for example, diagnostics via a progress tracking tool, which I'll elaborate a little bit more in a second. We also work on closing key research gaps by collaborating with universities, and also develop new data tools and methods, and also provide capacity building and trainings directly for central banks and financial supervisors. Maybe just to highlight the tool, because it's publicly accessible to all, so maybe also very interesting to the audience. So it's one of our flagship projects that is called SUSREG Tracker, another acronym that stands for Sustainable Financial Regulations and Central Banking Activities Tracker. And what it is, it's an assessment that we do yearly of central banks and financial supervisors across more than 50 jurisdictions. And we assess the extent to which they start considering climate, environment, and social concern in all their different activities. And we look at it quite holistically. So looking at climate, looking at banking and insurance supervision, macroprudential supervision, so the more systemic risk management from the side of the central bank and financial supervisors, as well as monetary policy. And this is also an important tool that we have to also discuss together with central banks and financial supervisors, as it creates kind of a diagnosis of where they're at, where there's already a lot of improvement, where the gaps still are, and it also fosters kind of a knowledge sharing platform between different central banks and financial supervisors, as there are common challenges as well. And within this tool, we also are increasingly integrating water-related indicators. So we're really starting to assess more concretely how water is considered. For example, to what extent are financial supervisors requesting insurance companies and banks to set specific do they have specific kind of expectations around how water-related risks should be integrated? And this is just an example. We actually try to kind of have a cross-cutting integration of water alongside kind of other natural realms topics, such as forest and ocean, across the different work streams that I mentioned earlier.
And maybe can I ask a quick follow-up question on what you're actually seeing then, looking at the freshwater indicators in terms of integration?
So we see that generally freshwater, and I think as we also kind of seen before, they tend to be captured within assessments done by central banks, when it's like risk assessment, stress tests via kind of climate-related risk assessments or nature-related risk assessment, but they still kind of occur in silos. And then interestingly, obviously they tend to be kind of very material in both. So obviously climate manifests a lot through hydrological related hazards. And at the same time in nature, the dependence is high when it comes to groundwater and surface water. But they tend to be kind of looked at in silos. And I think that is also what kind of inhibits the kind of prioritization along the policies. So on the one way, we see that it's increasingly kind of reflected within assessments that are being done to better understand the risks. But when we look at the kind of policies in the microprudential side and the macroprudential side, it's not really yet reflected, other than being integrated within this kind of broader umbrella term of nature and climate. But we don't see any kind of specific guidance that is yet given. There are some examples, but not yet to the scale that kind of matches or is appropriate to the urgency of the situation.
Okay, brilliant. That's really interesting to hear. And so from the WWF perspective, why would you say freshwater security really is critical for central banks to be looking at? And what kind of leadership or action do you expect from them?
Yeah, I mean, to be honest, this question I think has been, it's kind of implied already by the keynotes that we listened to before. I think it's become really increasingly clear how price, financial stability, which are the core mandate of a central bank and a financial supervisor, how they are at risk from nature degradation and climate change. And again, coming back to the point that within these kind of assessments, looking at physical climate-related risk and nature-related risk, the prominence of water cannot be overstated. It's just, it really is the kind of the red line or the blue line connecting everything. And at the same time, we're seeing that there's a sharp decline as well in freshwater ecosystems that are kind of the natural insurance, so to say, that is really de-risking a lot of like the effects from climate. And there are other drivers besides climate change that are having an impact in degrading these freshwater ecosystems and freshwater biodiversity that are, underpinning that resilience. And we are actively eroding that resilience. And so trying to connect all these thoughts, I think, would help to also understand broader issues and having this integrated lens. And so as much as the economy depends on a stable climate and intact nature, it depends on a stable and resilient hydrological cycle and resilient water related infrastructure. And so I can only really, otherwise I would be paraphrasing kind of what was already said before. So I'm not going to repeat it. I think it's kind of clear how it plays such a prominent role, and what we'd expect from a leadership perspective is to kind of acknowledge the urgency and also acknowledge the uncertainty that there is. I think there's sufficient evidence showcasing that we are in this dangerous zone, according to for example, the Stockholm Resilience Center, it's showcasing the planetary boundaries. When we look at blue and green freshwater change, we don't know, we might be approaching tipping points, we might have already crossed some. And I think acknowledging this and translating that into the policy of taking precautionary action is absolutely central, and would also send the adequate signals towards the market and really prioritizing these risks and better understanding them. And yeah, so really we kind of broadly would say to recalibrate all their tools, but I think to kind of sum it up, I think it would be to think about what can they do, acknowledging that they don't have the silver bullet, but they have a role to play, and to kind of think about how to tweak the kind of the powers that they have.
Thanks, Karen. That's really a critical point. So we briefly touched on from the commercial bank, what were the tools available to commercial banks, what's happening with central banks in general, and the tools are available and the tracking. And so now let's hear from a central bank, Kata, to hear about the experience of the Hungarian central bank itself. So can you tell us how the Hungarian central bank is fitting or is looking at climate and nature within its mandate? And then can you also tell me, is it quite typical to be looking at this, or is action within the central bank, not the usual, should I say?
Thank you, Laila, and also very happy to be here on this incredible panel and webinar, where at first glance climate and ecosystems may seem outside of a traditional remit of a central bank, I would say, but in reality, I totally agree, and there is emerging evidence that they are deeply intertwined with core functions. Our primary mandate, I would say, remains still price stability, but to deliver that, we must understand and anticipate the structural drivers of inflation and financial risk. And recognizing these challenges, actually, the Hungarian parliament amended the Act on MNB in 2021 to include the promotion of environmental sustainability among the bank's statutory objectives. So it's not just conceptual commitment, in our case, it's a legal green mandate, and it empowers MNB to support the government's policies related to environmental sustainability and economic resilience, using the instruments at its disposal without prejudice to its primary objective, which is price stability. So the green mandate does enable us to integrate climate and nature-related risk into our supervisory, regulatory, monetary frameworks in a systematic and quite proactive way. Now, is it standard amongst central banks? The green mandate, probably not, but it's definitely gaining traction, especially among NGFS, advancing this agenda that Sjord, I think, fantastically showed us. Objectively, actually, SUSREG by WWF that Caroline mentioned is really a great tool, and we also use it regularly to track our performance. And there's also the Green Central Banking Scorecard by Positive Money. It also is an excellent reference for evaluating and comparing central banks' sustainability efforts. And we do a self-assessment voluntarily to gauge our performance also there and identify truly where are the room for improvement and compare us to G20 countries where this particular assessment is typically done, and we are quite ahead of the curve here as well. But to just give you also a subjective recent experience, I just met 30 central bankers from over a dozen countries that came to Hungary for our technical assistance program a couple of weeks ago. And I talked to them about biodiversity and central banking, and just asked them, raise your hands if you touch upon this topic, have any work streams related to it. Only one single person raised their hands. So I would say that the inclusion of nature and ecosystems, especially water and biodiversity in financial supervision, still remains rare.
That's really interesting to hear about only one central bank raising their hand, but it's also fantastic to hear about the kind of knowledge sharing amongst central banks, to have that kind of that forum coming together and sharing knowledge. It sounds very impactful. So maybe a follow-up question. what types of supervisory instruments then are within the Hungarian Central Bank's toolkit that can facilitate economic transition, an economic transition that incorporates natural capital and climate resilience?
Thank you for that question. So whether it's through incentives, supervision, or disclosure requirements, or international research, MNB does have a, so to speak, a toolkit, if you like, with initiatives that reflect both the urgency of climate action and the foundational role of natural capital in economic resilience. So let me give you just a few examples based on our green program, some of which you actually might be able to recognize from the pillars that Angel introduced in his keynote previously, which I think was super, super useful. So a key initiative that we have is called the Green Preferential Capital Requirement Program. It's quite unique around the world, and it offers capital requirement discounts to banks that finance environmentally sustainable activities such as energy efficient homes, renewable energy. Not much on sustainable agriculture, for example, where obviously nature risks or water-related risks would come up and impacts are most relevant. And this is an area, for example, where we are looking more closely this year. And this particular tool creates a clear incentive for greener portfolios. And thanks to this, in Hungary, the green loan portfolio grew by half, reaching now total 3.3 billion euros. Another example is our green recommendation. It's both for credit institutions and insurers. It sets supervisory expectations to integrate environmental and climate risks into the management and decision-making processes. And this is also critical, I believe, for ensuring that these risks are identified, measured, and disclosed. We also recognize that we need robust data and research. So we have co-led in the past 2-3 years a joint research program with OECD, supported by the European Commission, on the integration of nature-related risks into the financial framework. And this collaboration really helped us develop both a supervisory framework and also a methodology for assessing the financial implications of biodiversity and ecosystem degradation. And it's an area where analytical tools are still emerging. And if you remember Sjoerd's presentation, the ECB study, he had similar findings showing us that water, surface and groundwater came up there and also within our study as providing key ecosystem services where the Hungarian banking sector is most exposed related to physical risks. So this kind of international cooperation is also essential in our supervisory toolkit. And as a follow-up implication of that study, now within sustainability reporting, as per our annual TCFD climate disclosure, now it's the first year that we are integrating some nature-related risks as well. So that's something that I'm very much looking forward to. And we also have the classic climate stress testing. We have green mortgage bond purchase programs. We have a green financial product finder, which is a more like digital platform, an innovative platform to help strengthen demand for green saving products and to create transparency for what is actually on the market. So just in conclusion, there are really multiple supervisory tools that are aligned with our green program pillars and where we have the opportunity, I believe, to steer the financial system towards supporting the economy that values and preserves natural capital.
Thank you so much, Kata. It's really encouraging and inspiring to hear, the range of tools that are being already employed by the Hungarian Central Bank. So thank you very much for sharing on that. So I'm going to do one final question going back to Kate and Carolyn. Unfortunately, we're running close to the end. So in 1 to 2 minutes each, I wanted to hear from your perspectives, from UNEP FI and WWF, what are you really seeing with the central banks that you're engaging with, and Kate, that can also be the financial institutions that you're engaging with, and what do you see as the real challenges, the barriers to moving further on assessing water-related risks and managing them, and where is further progress most needed?
Thanks,
Perhaps
Laila.
starting with Kate. Go.
Okay, thank you. And I just wanted to again also further acknowledge the work that Kata and her team are doing, as well as Sjord and Hella in the other institutions. It's absolutely amazing. As individuals, all of us on this call, most of us have been laboring away at the water world for 15, 20 years now, right? And what's exciting about the fact that this workshop is happening today and that we're getting stakeholders such as yourselves on the calls is that the message isn't changing, but the messengers are, and that's very encouraging for all of us on the call. So thank you for this. From our perspective, as we're hearing on the call today, right, there is a shift and there is a growing awareness among central banks that freshwater, the depletion of freshwater resources and ecosystems poses a very substantial challenge to us economically. We're sort of seeing that emerge within the commercial banking sector as well, although as Kata has illustrated, the numbers that are really taking meaningful action is you can count them on one hand. And that's just not good enough at the minute. We're not seeing the urgency, we're not seeing the sophistication, we're not seeing the money flowing and the governance changing within institutions so that these issues are taken and given the attention and the urgency that we need. And I think this is down to a range of issues. There's a lack of standardized disclosure requirements for water-related risks, not just, of course, for the corporations that depend on the resource, but also for the finance institutions themselves. And that means there's inconsistencies in how FIs report and how central banks can then manage these risks. There's also, I think, a need for more comprehensive hydrological data, the age-old call that we're hearing and very familiar with in our space, but for also tools and methods and guidance notes that specifically serve this stakeholder. Again, for those of us in the water community, it's a relatively new stakeholder. They speak a different language, and we've not been servicing them for the longest time, and that has to change. So I think to make further progress, we need to, as I'll echo Carolyn's call, for more central bankers to acknowledge the urgency of the issue, is that will really galvanize, I think, a much faster pace of action, both amongst the corporations and the banks themselves, as well as the national governments that are ultimately responsible for managing the issue. We need to see the integration of water risk assessments into supervisory frameworks. We need to see the promotion the promotion of standardized assessment and disclosure practices. And of course, I think importantly, I'd love to be able to see more central bankers working hand in hand with the ministries of environment or ministries of water from within their countries and also the countries that they depend upon, because they are the hydrological experts. And bringing these two skill sets together, well, the possibilities are endless. So I really look forward to working with everyone on the call today, really, to continue to advance this agenda. Thank you so much, Lila. And Carolyn, over to you.
Thank you. I'll keep it short because I think you covered it pretty much all, and I think I can only echo what you said. And I think overall, it's one of those. It's a challenge that won't be solved by one institution. It really requires this collective effort and collective action, and most of all, also coordinated action, which I think is one of the main challenges. It requires really different policymakers and stakeholders to come together in a synergistic way to really deliver that impact. And I think one thing I would just highlight as well is actually what was said at the very beginning, which was about the presentation on the NGFS on the endogenous risk, really also thinking around how the decisions made today by financial institutions, by central banks, by the economy are the risks of tomorrow as well. So really trying to connect and expanding the time horizons beyond the usual time horizons, I think is going to be key to also really make the right decisions for today, but also in the long term. So yeah, I'll close it at that, and thank you.
Thank you very much. Thank you. Thank you to all the panelists. This has been a really rich and insightful discussion, and I really look forward to continuing the dialogue. As Sjoerd said at the beginning, these types of conversations are really critical to keep moving forward. This is not easy. It's hard. We're working towards figuring it out in a sense. So these conversations are very, very important. So thank you very much to all the panelists, and also to Angel and Sjoerd, although apologies we couldn't come back to you in the questions. But I would like to hand over now to Josefina Meitzu, the International Water Advisor to the Spanish Minister of Ecological Transitions, who will be giving some closing remarks. Thank you.
Hello, good morning, good afternoon, good evening to everybody. there has been a very, very rich discussion and a lot of insights being given about this relatively new place where we are moving. As Katie was saying, we have been working for a long time in the water sector, but we haven't really been very successful at reaching out to other actors, like in this case, the economic actors. The main takeaways or the main conclusions that I take from this webinar, first of all, is that I think it's pretty obvious. Yes, there is a recognition now by central banks and some of the financial and economic actors that there are risks to the financial system and to the economy from nature-related risk and especially water. So very clearly, there is an awareness that this is happening. There is an awareness that we need to somehow also act on it. I think in the seminar, we have also talked about what are the financial actors doing about it. And we've seen that a lot of what is being done is about basically identify these risks, trying to understand the change of connections between the nature risk, between the transmission channels, between the final risks to the financial sector, and try to see what is the exposure of the banking system, for example, to all these risks. So there is quite a lot of work having done there. And for me, a very important issue that has been discussed is about to try to map this complexity and to try to understand better the feedback loops between both the natural system and the financial system, but also the other way around, how the financial system is affecting the natural system. So maybe that's something also that we need to build on. Very interesting, this type of discussion that has been going on this contagion effect, how, even if when there is an impact of a natural effect on the financial system, how this can have, consequences in the rest of the financial system that needs to be also considered. Beyond identifying and assessing the risks to the financial system, I think we have seen also that there are possibilities of taking action on that, and also to having a more proactive role from the financial institutions to try to improve water resilience. Angel was very clear that the governments need to do their job, because otherwise some of the implications of the possible measures that can be taken by the financial system can have effects on vulnerable groups, etc. But it is also true that we need to move beyond simply assessing the stress or the problems or the level of exposure to this type of risk by the financial system, and to move forward to try to do something about it. In that sense, I think the presentations of UNEP, the presentations of WWF, and very important, the presentations of Hungary on how we can promote different type of practices in the banking system, and not only be analyzing and identifying what the problems are. There are regulation tools, and Angel was very clear which kind of regulation tools there are. So those are the kind of openings that are there, and we need to work more on. Some sort of final ideas that I had there is that the WWF gave us a very clear statement about the tipping points that we are analyzing. So these risks need to be considered also in our analysis. Something very important that has been partially mentioned is basically the fact that a lot of the analysis of the risks of the banks so far have always been backward looking. We looked at what is the situation, what is the portfolios of the banking system, but now we have to move forward, and that brings a new type of challenge in analytical terms, that we need to look more at system analysis, and there is work, and there is a need for support by many of these institutions to the regulators and to the central banks. There has been a call, and I think I'd like to finish with that, about the need to really work better together and more together between environmental ministries and the financial institutions in the public sector. So that's all from me. Thank you very much for your attention, to all of you. And thank you for staying with us, and thank you to all our panelists and speakers. And I hope to see you soon. Please join the initiative if you find this interesting. Thank you to all. Bye.